Welcome back. We'll be looking at Asian markets just because, they have been sputtering around here and there. Mild green for most of the indices, but the early rates for Hang Seng indicated an uptake. Then they fell off, currently just about flattish. We have the Shanghai index doing fairly well because most of the Asian markets, remember, have already reacted to the good data coming in from China as far as the GDP growth is concerned. The Korean market, of course, aided by Samsung Electronics, which is high by about 1.5% owing to the management restructuring that they've announced. The SGX Nifty, in light of that, indicating a positive start to the tune of close around 14 to 15 odd points. At the start of the show, this was around 30 points. So mild green sputtering is what one can say in an otherwise strong environment for global growth. But we'll also be reacting to a whole host of earnings this time around. Over the last two trading sessions or 2 days itself, we've got earnings coming in from nearly 25% of the Nifty. We've discussed Reliance, HCL Tech and TCS. Let's talk about HDFC Bank. Has around 11% weight on the Nifty. It's delivered a mixed bag. The gross NPAs rose quarter on quarter, while as the retail loan growth was the weakest that the company's ever posted. Abhishek's here with the fine print of the numbers. Abhishek.
Well, it's a mixed set of numbers coming in from HDFC Bank. The corporate loan growth is at 3-quarter high, and the net profit, that crossed the 30% level for the first time in last 12 quarters or let's say 3 years. The declining trend of low-cost deposit have been arrested, which led to sustainability in the net interest margin being stable at 4.2. However, negatives from the results are the slippages that increased to 5,340 crore when compared to 3,714 crore in the previous quarter. The retail loan growth is the weakest, and NII growth is the weakest ever at a mere 12.8%. NII growth is weak on account of two reasons. One is the change in loan mix, and the other is the bank actually parked close to 8% of its net demand and time liabilities with RBI versus 5% average earlier. Due to elevated slippages, asset quality also deteriorated. In absolute value, it increased by 7.5% quarter on quarter. While NII missed our poll, the profits were higher due to robust fee income, operating efficiencies, and a bit of lower tax rate. Let's hear out the management what they have to say about the results.
Core slippage that we referred to 1.7% represents a slippage of 3,839 crores, right? 3,839. The total, which includes that lumpy one-offs, agri, and all of them, let me see, that's between them roughly approximately 1,500 crores.
In the board meeting, I think they have sort of agreed upon the search firm who's going to help in the search process. Normally, we would expect the bunging in the applications for to the regulator for approval somewhere around July, August. I think that's the time that we should see. We would have finalized. We would have had the candidates shortlisted. Number 1, number 2, number 3 for RBI to approve.
Okay, that's the word coming in from HDFC Bank. But Abhishek, stay on. Kotak Mahindra Bank too will be announcing its Q3 results later today. What is the street expecting?
Well, the key things to watch in Kotak Mahindra Bank will be the net interest margin being sustained at 4.6% or above. Given the fact that this is at 18-quarter high net interest margin, the loan growth should sustain above 15%, which will be positive. The fee income should remain strong on account of the retail loan growth that they are seeing and also digitalization through which they are getting loans. The low-cost deposit share for Kotak Mahindra Bank is one of the highest in the street at 53.5%, which is aiding the net interest margin. Their asset quality should remain stable. Anything below 2.4% in terms of gross NPA will be taken positively. Our poll suggests NII growth of close to 20.5%, while net profit can increase by 32% plus. Back to you.
All right, Abhishek, thanks a lot for all those details, but it's time to slip into a quick break. Up next, JSPL also will be in focus.